The PPI cooling in September, according to the latest data out this morning. This after yesterday's CPI number showed inflation slowing. Those data points adding to the questions now over how the Fed might move at its November meeting after that supersized 50 basis point cut in September. Here to share her outlook is the former Cleveland Fed president and CEO Loretta Mester. It's good to see you. Welcome.
Hi, Scott. Thanks for having me.
Would you have gone 50 at the last meeting?
Well, I wasn't at the meeting, so I don't know.
You're allowed to say now. That's why.
I am allowed to say. You know, I thought it was a close call. I could have made a case for 50. In retrospect, of course, some of the data that they were worried about in terms of the labor market data got revised away. So I can imagine that, you know, now in retrospect, they probably thought, well, we could have gone 25. But the basic narrative hasn't really changed that much with the data we've gotten on both employment and inflation. I think the basic narrative is the same, which is, you know, over the next 6 months, 7 months, 8 months, the median run outlook, right? They expect inflation to continue to move down at a gradual pace, and they want to do what they can to keep labor markets healthy. And while there's probably a little more strength in the economy than they saw in September, I don't think the narrative had changed. Some of the risks have changed around that, of course. I think there's less downside risk on the employment front than they saw in September. But I also think there's probably a little more upside risks on the inflation front than maybe they were expecting. So I don't think the basic idea of, you know, we're trying to move rates to a more neutral stance over time has changed. And I would expect that that would be sort of what they discuss at the meeting going forward, which is, you know, has something materially changed that we want to really move off of that phase of normalizing rates. And I just don't see it in the data right now. I think the data is pretty compelling that, you know, it's coming in about what they expected, a little more strength on the employment side, which is a good thing, I think. Less downside risks there, and inflation moving gradually back to 2%. Remember, in their forecast, the median forecast didn't have inflation reaching 2% in next year. So, I mean, it's basically on track, I think, with that kind of slow, gradual, but more confident on track to get back to 2%.
I want to ask you about, you know, the median projections and the forward guidance and all of that, because some are taking issue with it to begin with. There's Stan Druckenmiller, who's one of the most famous and successful investors this country has ever seen, who said, quote, "I hope the Fed is not trapped by forward guidance the way they were in 2011. I mean, Larry Summers made the point after the jobs report following 50 basis points, which he thought, by the way, was a mistake, to where he said, quote, "Today's employment report confirms suspicions that we're in a high neutral rate environment where responsible monetary policy requires caution in rate cutting." I mean, how would you assess what both of these well-respected economy and market watchers have said?
Yeah, so I do believe that probably interest rates, the neutral rate, is higher than it was in 2014 through 2019. I think there's a lot of reason to believe that. But, you know, the Fed rate, the funds rate, is high relative to where inflation has come down to. So, in other words, you know, if you don't move rates down gradually, you will be inadvertently tightening. And given where the economy is and where inflation is relative to goal, I don't think that's necessarily appropriate. But they're right in the sense that you always want to keep your monetary calibrated to the economy and where it is, but also where it's going. And so I think there's still room to do some cuts in a gradual way, you know, next meeting, the following meeting. And, you know, before you get into that realm where, okay, we don't really know where neutral is, maybe we need to sort of be even more gradual than we've been. So, yeah, we'll get to that point, you know, but when we get down to 4.375, I think that's where you have to sort of be cautious because we don't know exactly where neutral is. And you'll let the economy tell you sort of how it's behaving, and that'll give you some good clues about, you know, are you getting to a point where it really does seem that you've settled into price stability at 2% inflation and maximum employment, where maximum employment, of course, is the employment that's consistent with price stability. So I think the economy is going to tell them, but there's still some room to go on that funds rate, the nominal funds rate, before you get into that area, I would say.